And welcome back, everyone, here to Live Now from Fox. I'm your host, Mike Pache. Always great to be with you as we continue to roll on. Next story, it was one that we were looking at all day today with the stock market and stocks posting their worst day in over a month. Wait, you're telling me the stocks just don't go up all the time? Well, sometimes it has felt like that in the past, especially with AI tech stocks that seem to really, of course, be the darling of Wall Street. But today, not so much. So we're going to break it all down right now. We have our next guest to help us do that, to help us get through what we could see possibly tomorrow and maybe into the future. Please welcome, everyone, Eric Teal, Chief Investment Officer with Comerica Wealth Management. Great to have you on. And first off, what did you make of today?
Well, Mike, I mean, we've set new highs for several months now consecutively. Markets trading at from Nasdaq to growth stocks overall setting at all-time highs. So, a pullback at some point, given the momentum in the market, I think is to be expected. Not something that's uncharacteristic at this time. However, you're seeing elements of the market that are the most frothy pulling back significantly. Tech stocks trading at valuations now 45% above the rest of the market. So, that gives investors a lot of concern. And what you've seen is this sort of high momentum market turning on a dime. And that's exactly what's happened here.
Yeah, and I think what a lot of people want to know is, okay, is this just maybe a small correction, or is this something a little bit that could continue to spiral in the next coming trading days?
Boy, Mike, we've come so far so fast. 8 months. I think if you step back and you say we could have more of this, I think if anything, we've had pretty muted volatility at this point in the market. As that goes, I think you will expect volatility to pick up, and that's probably the surest bet we would have in the market. And volatility, of course, works both ways. And so I think, doesn't mean all going down, but I think there is a little bit of retail money in here that's driving markets a little bit too far up and too far down in both directions.
Yeah, that's such a good point. And I mean, when we take a look at even a particular company like Oracle, just last month, we saw them about maybe $90 higher than what they are right now. What do you make there of Oracle really maybe coming back down to reality or earth a little bit?
Yeah, I think some of the best plays in the market are which we define as some of these chicken AI companies that trade at reasonable valuations, but are not at such lofty multiples that they're a pure AI play. I would put Oracle in that category, along with companies like Cisco and Dell. Their retracement, I think, is reasonable and probably has some margin of safety as compared to some of the other tech stocks where they're trading at such high multiples. So, if I was going to invest heavily or overweight tech, I would make sure to have some exposure to those sorts of companies that have support on the valuation and very diversified and not a pure sort of AI play at this juncture.
And where we're at right now with really on the cusp of AI and just seeing so many different companies continue to talk about it and really what the future will hold. And I mean, even when they're doing their guidance, they're talking about the money that they'll be making in the future from AI. How does this compare to like late 90s, early 2000s with the dot-coms?
Oh, very similar. I mean, in terms of the momentum that's driven the market is comparable to what you had in 1999, that period. Of course, the companies are much better quality. There is more cash flow generation here. The multiples are now getting, compared to the rest of the market, getting quite extreme. However, this can continue along for some time. So I think the quality's better. There are real earnings. However, the sort of momentum that's driving these stocks and the thematic sort of characteristics really harken back to the late 90s. What we need to see, Mike, is the productivity gains come in next year. And that needs to sort of start trickling down to smaller companies who will benefit from this. So we're really monitoring capital expenditures at this point, making sure that that doesn't get out of line and that, we're not chasing strategies or investments that don't increase productivity. So all of that's going to be really important as we get into earnings in 2026.
Yeah, no doubt about that. And when we talk about earnings, I think a lot of people are going to have that bullseye 6 days from now for Nvidia to report there. Again, it seems like all eyes are always on them, where they can make or break really the next really trading days.
Yeah, those companies in that sort of Mag 7, all eyes are on them. So far, they delivered. You're seeing a lot of positive impacts from trade and tariff for technology companies. But what we're cautioning investors is let's look outside of technology for companies that might benefit, areas that have been forgotten in the market. And so if you look at financials or areas like small cap, even international, that for the most part have been ignored by investors as the retail and momentum has chased really tech stocks, buy on the dip mentality. So I would encourage investors to look at those that have been forgotten, even energy companies, Mike, that have reasonable valuations. Oil's come back here a lot. Those are sort of the opportunities, I think, that provide, again, some margin of safety and a dividend yield to boot, but you're not sort of in the seventh or eighth innings and worried about, well, if the music stops and the bottom sort of falls out of this, which we're not forecasting, but you need to be mindful of sort of that in portfolio construction, that you have a well-diversified portfolio.
And Eric, what about we've been talking a lot about the tech stocks, obviously, but what about metals? What about junior miners? Is it too late to get it? They have had such a run this year. Is it too late to kind of look at that, or is there more potential for upswings again?
Mike, couldn't agree more. The mining companies, very different than the commodities themselves. I think there's opportunities in gold mining stocks, the junior mining stocks. All of those have not had nearly the appreciation that you've seen in the commodity itself. So the quality of those companies much better than they were several years ago. So I think just like when you look at sort of oil and drilling companies and compare that to oil prices and commodities, there's those, they don't always trade in tandem. And so even though the commodity, gold and silver and precious metals have had a tremendous year, I think there's still lots of opportunities in the mining companies at this point.
And where do you think those metals would be at today if we didn't have the digital currencies, if we didn't have the Bitcoin, where it seems like a lot of people were going for that, still do? Obviously, that's a whole another group and really story here. But for a while, it felt like the metals weren't catching up, and then all of a sudden they've had a nice increase. But if there was no digital currency, I mean, how much more of a swing on the up could these metals have had?
Oh, I think they could have significant upside from where they are today. We pay a lot of attention to that relationship between gold and Bitcoin. And so a lot of the money, I think, has gone into Bitcoin, could siphon right back out and go into gold or silver, for example. I mean, both of those have, I think, first probably started to appreciate because of concern about debt deficit financing and debasement of the fiat currency. As we've gotten further along, I think they've appreciated because of inflation concerns that continue to mount, and then long-term structural deficit concerns that are overhanging this market. So I think gold is moving more than just sort of a market fear factor. It's moving for a lot of fundamental reasons. And we know that historically it's been one of the best hedges against inflation. And so that has not calmed down. It's still very concerning if you look at Fed policy. I think long term you have to be mindful of inflation. And again, one of the best hedges there has been gold, and precious metals have industrial use, and we're seeing that in silver and copper. And I think those trends are still in place and will be with us for some time.
There we go. And then finally, to bring it all back to the front here, futures doesn't seem like too much of a change so far going into tomorrow. What are you feeling? More of a hangover day, or maybe a little comeback?
Boy, Mike, we've had this buy on the dip mentality. I think because there's such a strong retail component to this market, you're likely to bounce back. And there's nothing to me that's sort of been fundamental to shake the confidence of investors. We would have to have, as you mentioned earlier, Nvidia or some big sort of significant disappointment, I think, to rattle the confidence of investors. So, I think at worst, we tread water, but more likely, I think we're positioning for a rebound or some, finding a bottom here and beginning to show some upside.
There we go. Eric Teal, great to have you on. Always great to speak with you, and you have a great rest of your evening.
Perfect. Thank you.
Take care.